Hi everyone, let's go over my micro, bullish and bearish Elliott Wave scenarios on Bitcoin, starting with my triangle double fakeout scenario where we're expecting a move to the upside, then down, before then returning to the upside to reach the blue target box that we have over here as resistance, sitting between 30.5k and 30.7k. Because price is moving in the shape of a triangle, you hear many people online talking about a triangle scenario. However, when we look at the Elliott Wave rules of a triangle, there is a problem going on for me with the first rule over here, which says that 4 out of the 5 waves have to be a zigzag structure, which is a 5-3-5 wave move, either way, either to the downside or to the upside. But if we look at this move to the downside over here, which is then the potential wave A of a triangle, you don't really see a 5-3-5 move to the downside. You can count, however, an impulse to the downside, which then is a 1-2-3-4-5 wave move. But we never got a retracement up and another 5 wave move to the downside. So instead, what I am looking for over here is a potential zigzag scenario where we have a 5 wave move to the downside, followed by a complex wave B, before then wave C towards the downside, and then a 5-3-5 wave scenario where the invalidation is if price is going to take this high over here. And a double fake out scenario is something that happens more frequently because in May this year we saw this over here. This is a screenshot that I took from a video that I recorded in May, where also many people were looking for a triangle, but we were looking for a double fake out, moving up, moving down, crossing the triangles lines, the trend lines twice, before then returning towards the upside. And if we go to the 1 hour chart, and I actually bring you to May, so we go in the past for a short second, then the scenario that we have at the moment looks very much to what's happening over here, where we then have a move down, fake out above the upper trend line, faking out above the lower trend line, and then the real move actually starts towards the upside. So this is something that I'm looking for at the moment on the lower time frames, which then is the 15-minute time frame. And this scenario over here fits very well with a potential WXY scenario. So what we're then looking for over here is that we have 3 waves in a wave W. Then inside of this wave X, we're looking for a zigzag structure, and then a wave A, 3 waves in B, before then a wave C to the downside, finishing wave X, maybe taking some liquidity of some lows that we have over here, and we also still have some support to the downside where we have a daily at 29.9k, time naked point of control at 30.075, and a daily naked point of control at 30.125. So we have some interesting support at the lower areas as well to maybe bounce for then a wave Y towards the upside. Not to forget that price now also formed a double bottom over here, and we have a double top. So how interesting would it be for price to maybe take the liquidity over here, move down, take the double bottom, maybe move down a little bit further, right? Faking out that triangle, then move to the upside to take the double top, reach the blue resistance area that we have over here, before then moving towards the downside. That I think would be very interesting and also in line with the CVD divergences that we have over here. So if we look at the CVD divergences, all the green lines are CVD divergences, with the horizontal lines being the targets for the bullish CVD divergence. So CVD divergences have been building, price making higher lows all the time, while the CVD chart was showing lower lows all the time. Even locally over here, we have a higher low in price, lower low on the CVD, where the target just now has been taken with this move to the upside. However, also here, higher low in price, lower low on the CVD, where the target is this high. And that's why I think it is so interesting in this scenario to take this high, make this bullish CVD divergence play out over here, then move to the downside, right? And then what happens is as price is moving to the downside, the bigger bullish CVD divergence that I have over here is going to move to the right side. So we then have a higher low in price, lower low on the CVD, for then a move to the upside to take the final target over here of this bullish divergence. If we go to the CVD chart, and I zoom out to the 50-minute time frame, you can clearly see the bullish CVD divergences where price is moving over here to the upside with higher lows, but the blue line consistently making lower lows. That is a bullish CVD divergence. And then over here, the yellow line started to do the same. Higher low on price, lower low on the CVD, where then the target is this high. So that's why I think it's so interesting to take this high first, faking out the triangle up, then faking it to the downside, before then with bullish CVD divergences as well, taking out this final high to then reach this target area. Of course, that is the scenario that is currently preferred. In a bearish scenario, we just dump, but honestly, that scenario to the downside is not really something I'm looking for. I prefer, if there is an alternative scenario, for price to just continue towards the upside, but I think that this scenario would be absolutely brilliant. Fake out the upside, fake out the downside, just like in May earlier this year, before then moving towards that blue target box that we have between 30.5k and 30.7k. If we then talk about the probabilities, well, I prefer the triangle fake out also from a trading psychology point of view, because you're going to be breaking, or you're going to be faking out many retail traders that are potentially trading in the weekends. What are the first things that you learn as a trader most of the time? It's going to be patterns and trend lines. The pattern that you see is a triangle based on the trend lines that people then use. So the rule of a triangle says that if you get a fake out, or for example, like we just got now over here, a candle close above the upper trend line, you can then go in along, stop loss somewhere over here, maybe in the triangle or on the other side of the triangle to maybe play it safe, and then you're going to be looking for higher targets. But what's interesting is that when people then enter over here, the high gets taken, or maybe not even, we got to wait and see, but then you're going to move it to the downside so that the stop losses are going to be triggered. Then you have the people that say, oh, wait, we go to the downside, right? Breakout down. So they're going to be breakout shorting over here, right? And then they, again, put their stop loss somewhere in this triangle, whatever. And then they're going to be looking for downside. So you're basically going to wreck the market on both sides, which happened in May, right? Which was a brilliant scenario back in the day. And now we have to wait and see if this happens again. Now, my alternative scenario, as mentioned, is price moving to the upside to just take this high, right? Because that is the invalidation for a zigzag, which is a 5-3-5 wave move. The invalidation is taking the high over here at 30.460. But this at the moment would be my preferred scenario. So that being said, I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.